Hey everyone, it's Mark Montfort here from Not Centralized, and I am back for another episode of the FEX Insights podcast. This is episode 9. We've got a special one in this episode. They're always special, like my special guest. We won't have Arturo on for this one, but we are diving into something really important that we started talking about in previous episodes, and this is with a researcher from Kaiko. So we'll see Adam in the guest slot as we talk about TVL and just better ways to measure real-world asset tokenization projects. But first up, we're going to dive into the news. The first thing we're going to cover is how crypto can be analyzed with AI tools, and I've got a bunch of them to show you here. Firstly, let's check out Grok 4. So as you can see here on screen, this is the one that you get when you have a premium subscription account to Twitter, or X as they call it. So you can see here Super Grok on the side. And what I've asked for, and I've done this across a bunch of different platforms, is give me an analysis of ETH and BTC ETFs. I saw the folks at Bankless talking about this. And I also saw on LinkedIn that someone had shouted out from, I think it was Apollo, that asset manager here in Australia, looking at the Sol ETF, and it's just started its issuance. So we're looking at that one too. So I said, give me an analysis of ETH and BTC ETFs versus how the new Sol ETF is starting out. And here we see X, and I will publish these so that you can actually see the full versions of this research and compare for yourself as well. You can see here BTC, ETH, and Sol, what it's doing currently, and you can see the BTC ETF analysis. It's definitely been the gold standard of crypto investment vehicles, drawing in over 50 billion in total net inflows since launch. In 2025 alone, that's $14.8 billion, so quite high there. The ETH ETF is following a similar trajectory. More recent surge in momentum, we've seen Vitalik more in coverage in the news. Since their debut, they've accumulated over 5.5 billion in inflows. So still behind Bitcoin, but as expected there. And then over to the Sol ETF. So the Rex, Osprey, Solana plus staking ETF SSK launched on July the 2nd. It's the first US Sol ETF offering 7% staking yields, a feature absent in initial BTC and ETH spot ETFs. It debuted with 33 million in trading volume and 12 million in inflows, described as a healthy start by Bloomberg analysts. So given the green thumb there, which is great. Comparative analysis, as you can see here, Super Grok, as I'm using here, creates a nice table. Total inflows are there. Recorded daily inflows are Sol, definitely lagging, but that is just debut, so that's fine. You can see the debut, though, day volume. It's not shown here on these. We'll take a look at some of the others. Price impact plus 25% year to date, but Sol, it's not really comparable there. So interesting but limited analysis. It does show you the sources and web pages that it gets it from. You'll see that here on the side. So to just be able to maybe spot check some of those and see if that is true. And then you've also got our good old ChatGPT, and my goodness, it did some really in-depth analysis. So it'd be fun to publish that one, but I asked the same thing, started off with the same question. It's interesting because it doesn't just answer straight away. It actually comes back to you with some analysis first. Oh, it comes back to you with some questions first. Are you looking for a comparison in terms of performance or investor interest, etc.? I said all of the above. Do you want to focus on spot or include futures? I instead include futures, etc., etc. And then it does the analysis. It did its work for like 9 minutes. I've seen work where it's gone up to like 30 minutes, 40 minutes, an hour worth of work. So really interesting. This was done while I was at a cafe this morning, so you can see. And this is filmed on Friday, the 18th of July. So just to date where things are at. You can see here that there's the historical development of Bitcoin and Ethereum ETFs that it covers here. A lot of news, a lot of sources there. And then it dives into the fund structures for spot and futures ETFs. So a lot more of the history, which is really interesting. And then we go into regulatory landscape as well. early reluctance and the rationale of the SEC before until it was approved. Even Gensler's approach is mentioned there, and the tide turning in 2024. That was after a legal victory by Grayscale in August 23. We also see altcoins and Solana as the next frontier that's highlighted there, as well as the political institutional pressures as well. Obviously, we know that the tides have definitely turned in the US towards crypto in general, and definitely the impact is there for crypto ETFs as well. Current outlook, investor sentiment, and insto adoption. We also see here further down performance and volatility analysis. This is really, really in-depth research. I come from a background of working in equity research for a couple of years, both in Australia and in London. And yeah, this is definitely, whilst not visually appealing, but as an analyst, former analyst, reformed analyst, you could take something like this, clean it up, and basically put it into a research report after checking, of course, the sources. Trading volume is mentioned here, some macro information as well, which is really interesting. The new Solana ETF developments in the US market. There's also, what have we got here? Key proponents and differentiators, Van Eck, 21 Shares, Grayscale, Bitwise, all mainstream ETF providers in general, and now looking over to the crypto space. You can also see here, as we get towards the end of this report, comparative overviews and a nice looking table over here. So expense ratios, assets and flows, market reaction and sentiment being extremely strong for these, and performance and volatility, as well as a conclusion, probably the most comprehensive of the three that we're going to see. And the final one that I'll show is basically perplexity. And the thing that I love about this is that it produces charts as well. So you can see an ETF assets under management comparison. And then we also see an ETF timeline in terms of when they were issued. So some interesting stuff there, future outlook and investment implications, but much more to dive into. And I will share these reports. Look out for a link in the show notes. Another interesting article here is from the Financial Times, and what they've covered is this eye-catching headline, I would say, that tokenized stocks may not be for everyone, but they are for anyone. And it's not a positive article, but we definitely have to highlight it because we would be nothing if not for the critiques. And we definitely know of many ways that the crypto space can do better. So as you can see here, we've got Hester Peirce at the DC Blockchain Summit. And it says here, and this is definitely an opinion piece from Bryce Elder, who's written a lot about this. I forget if this was in Alphaville. It is. We tried Value Reader. We really do try. We want to approach all types of tokenized finance with an open mind. Maybe one day someone will invent something to do with a blockchain that's not crime, self-enriching, grift, black box frippery, or a distributed Ponzi scheme. I guess they've never heard of workflow efficiency. And hopefully we'll be able to show that with, as we spoke about last week, Project Acacia. They said that they're ready to reverse ferret on a long-standing editorial line should useful innovation ever happen, so we need to put in the work. But sometimes we just want to skip all that and show you a press release. So here's a press release from IoTeX, the exchange, saying that they've just rolled out a major integration that brings Wall Street to Web3. The IoPay wallet now fully supports Xstocks Fi, synthetic stock tickers that you might have seen from the likes of Robinhood and others. Their take on it is that, not a great thing. They see that there are a few reasons why a person might prefer to own a private market IOU, and they see it as an IOU rather than a stock, which, to be fair, is the case. Rather than a stock, maybe they want 24-hour trading or to put more trust in settlement by distributed ledger than via a regulated broker, or just want to swap tokens for other tokens via liquidity exchanges. Now, the thing about this is that there's different, I would say, nuances, devils in the detail. You could have, on the surface level, people might say that more trust in regulated brokers than in blockchain. But if that blockchain is run via software and processes and you have some transparency over how that works, I would argue that that is much better, because you could still have a regulated so-called trusted broker that's very human-led, paper-based, systems-based that are not interconnected. That's going to be a harder system to trust. So just saying at a surface level is really not good enough. would expect better from the Financial Times, but it is what it is. We are still in a space where even we see it in the crypto space with certain things like misreporting of, for example, Project Acacia, the folks at Cointelegraph. When I say the folks, it was particularly a writer there, spoke about how there was a granting of a reprieve on the types of licenses that you need to do something in a regulated market way. But that does not mean just because there's a reprieve that illegal things are being done. And they use the word illegal. We've got to be very, very careful with how we present things because it just eats and speaks to a narrative that might not be the case. We need the truth out there. We need better systems. We need better software. Workflow efficiencies are definitely a thing that tokenized stocks can have, but it was right to point out here, as the FT has done, that unless you're actually doing things that are tied to real ownership, whether it's legal and other regulated ways, it might be nothing more than IOUs, just like you see with NFTs, where you could change the picture in the background. The critiques are right. This is important. We do need to cover off on this. The next one I want to cover off is a great share by John Ho over at Standard Chartered. You may remember him from some of the crypto conferences that he has traveled to here in Australia, or you may have met him overseas, but he's part of Standard Chartered, a great crew of folks over there. Renee Michaud is also there as well, expat Aussie. John comes down to Australia, so I feel like he's an honorary Aussie. But he's highlighted here this report, as you can see, loading up on LinkedIn, 62-page report, Euro money tokens, potential economic role of CBDCs and Euro-denominated stablecoins. Just some highlights that I have there from that. Some of the key themes that I saw were stablecoin issuance and revenue models. The report detailed the business and operational structure of stablecoin issuers, highlighting the significant costs related to regulatory compliance, reserve management, and infrastructure. Another one is that digital finance and capital markets modernization was a theme with a strong emphasis on leveraging digital technologies, i.e. DLT, AI, and all those things to increase efficiency, deepen capital markets, and support new financial products like stablecoins. There was also the geopolitical and monetary dynamics. The report discusses a shifting global reserve currency patterns, particularly the declining share of the US dollar, and then the role of CBDCs and stablecoins. The analysis distinguishes between wholesale and retail CBDCs, which is great, public currency-pegged stablecoins, and their complementary roles in future financial ecosystems. And then there's investment and policy challenges, etc. But for more on that article and to flip through that, as you can see here, definitely check out the link in the show note. And thank you, John, for sharing that. The next article here is from Anton Golub, and you can see that it is talking about how with the Genius Act, it means that Wall Street not only just got a green light to hold your crypto and to do so now, that this is a really interesting thing between, in terms of starting a war between US banks and crypto assets and basically infrastructure providers. The full crypto permission coming from the big three bank regulators in the US has come. Real war is starting between US banks, and it's about stablecoins. Banks aren't just preparing to hold digital assets, they're preparing to issue stablecoins. And we see this sort of stuff. I think it was, I don't know if he mentions it here, but for example, a Citigroup earnings call talks about the need for them to create stablecoins for themselves. So you can see here that Tether and Circle already dominate the $260 billion market. JP Morgan launched JPMD, as we've covered in the past. Treasury-backed stablecoins are already moving from pilot to product, and every US bank now has regulatory runway to compete. The next phase is looking at US banks minting public dollar stablecoins on chain and at scale. Given that they've got arguably wider coverage than crypto, that's the traditional, that's the mainstream. Everyone has and works with and has to use banks. Crypto is growing more and more, but they are not the big dog in this. Given that the green light is now there, it's going to make for very interesting times. Could we see mergers? Could we see the collapse of some crypto companies as they are just not able to take off as much as they have? Mergers between other crypto companies just to compete. We will see, but more in this article. The next one here is, as I mentioned, I knew I had seen it. It's this post from Simon Taylor. Citi unveils its stablecoin strategy. So that's Citigroup there, and they highlighted that they're looking at tokenized deposits becoming the settlement layer for everything: stablecoins, on-chain FX, tokenized securities, and everything. What they said in the earnings call was that we are looking at the issuance of a Citi stablecoin, but probably most importantly is the tokenized deposit space. Everything being tokenized, maybe even the weather, we will see, but more on that in this LinkedIn post. Here's an interesting article about a Bitcoin OG who's shifting his position in terms of belief in Bitcoin, selling off most of his Bitcoin. You may have heard of, and if not, worth looking up Willie Wu. Willie is from New Zealand. I believe he grew up there, or maybe he's from Hong Kong and grew up in New Zealand. And you can see here some of the things that he highlights, such as this tweet here where he says the original price of Bitcoin was determined solely on energy value. The first BTC pump happened when price discovery pivoted to demand and supply. It went from 7 cents, or 0.07 cents, I should say, to 1.36 cents. That's a 19x in one day. Now it's at 120K USD, which is really interesting. So yeah, born in Hong Kong, raised in NZ, and he created things such as the network value to transactions ratio. This compares Bitcoin's market cap to its transaction volume, created back in 2017 after being asked on social media what was the closest thing to a price to earnings ratio for Bitcoin. And you can see there his post from 2020. So the strategic move that he's got here, he's effectively called the Wu charts. He's known for being decisive pivot towards Bitcoin venture projects. He's investing in things that will long-term benefit the Bitcoin cohort, so not just Bitcoin itself. So yeah, really interesting stuff. Some warnings there on how to be strategic when you do this, some other further tweets that he's had over the years, and definitely just something interesting from a Bitcoin OG that may be useful for what you're doing in terms of your analysis and research into the space. Worth checking out. The next one that we've got here is, as you would have seen from the previous episode 7, Arturo and I spoke about Project Acacia. There's 19, in fact, different pilot projects, as well as 5 proof of concepts. So the 19 are with real money and not centralized. We're proud to be leading one of those. I just wanted to share with you a page that we're creating, and we'll share soon, that has some more details about it. But I'll use this chance to basically show you what we've got here. So we've created this landing page. Our project is on programmable securitization of real-world assets. And as you can see here, just some highlights on the front overview page. So first up, we just wanted to highlight that this is the first time that it's being done on a public blockchain. You can see here that Red Belly is the first to do that in a central bank initiative like this. And given that it is real money, I think it's quite interesting. Institutional grade security that we get with this, with the different partners such as Fasanara Capital. We've also got Fireblocks, Paid. We've got groups such as Perpetual and AMAL also being part of this, as well as the Oz Bond Exchange. So really interesting stuff there. Definitely institutional grade things happening. We're bringing in smart contract automation as part of this too, as you can see here. And then we get to see as part of this participants as well. So not centralized as the lead participant, along with Red Belly Network, Paid, AMAL, Perpetual, Oz Bond Exchange, Fireblocks, and Fasanara. You can click on each of these tiles to get more info about their role in the pilot and why they matter. And you can click, as I can see here, on all of the different participants. The next thing that you can do as part of this application is going to be the workflows. So this is the end-to-end workflow explanation here. And our use case, unlike the one that we did in 2023, is much more end-to-end. There is more of the value chain that we are capturing in terms of showing how it goes from traditional finance and how you do things to an on-chain world and the benefits of that. So you can see here, first of all, the different steps going from invoice creation, Paid being part of that, transfer to trust, AMAL. Then there's asset pool formation, bond structuring, bond issuance, market listing, investment, invoice repayment, coupon and yield distribution, and with Red Belly Network as the infrastructure layer underneath all of that, along with Fireblocks for custody. But what we've done to make it even easier to understand things is as you go through each, when you click, you can see a comparison of the traditional process of how things work versus what does the on-chain process look like. And a process overview too. And you see the key benefits that we see here. So for the invoice creation, it's faster execution, reduced costs, enhanced transparency, automated compliance, and risk management. If we go to asset pool formation, step 3, you get faster execution and settlement, again, reduced costs, 24/7 availability. And you can see here, more importantly, the traditional kind of process. So it used to require manual aggregation of documents, complex legal structuring, extensive due diligence, and multiple intermediaries. Now it is far different on chain. The next part is that you see the what's next. This is definitely for us, as we mentioned, more of a proving ground, not just a product. This is going to lead to not just securitization, but other forms of tokenization. You can see more on that. Stay tuned for updates, and we'll cover off all of that the next time we speak about it. The next one that I wanted to highlight was that Arturo and I were also on another podcast. This was for Red Belly, and given that they're working with us to do the participation for Project Acacia, I thought it was important to actually get him on the show as the lead participant, and we spoke about things beyond just securitization. So previous weeks, he spoke about things with Alan, as it was just announced on the day that they were able to put that out, that the RBA and DFCRC announced the different pilot participants. We spoke about our use case. Here we go into that detail and beyond. You can hear Arturo here.
All right. But at the same time, usually you go to the bank and you get a mortgage and you can do a bunch of stuff, right? So you can use your house as collateral. But it's clunky. It's a difficult experience to go through. To use your house as collateral, it's a highly controlled exercise because banks will only allow you to use that collateral in certain circumstances. And on top of that, houses are not the only form of value that you actually have. So
really interesting stuff there. We dive deep into securitization, just other areas where this sort of project plays in terms of the types of value that we're demonstrating by moving from traditional to on-chain, what that could mean for future projects for Red Belly and many others, but definitely worth looking at here. This is Red Belly Insights episode 12. And that's it for the news this week, folks. Stay tuned for more news next week as we dive into more details, whether it's the interactive stuff that I'm showing you here. There will be much more of that. I'm actually adding an AI layer over the top of that website so it's easier to explore. And tune in for more guest interviews. We'll have Arturo back on for a deep dive. But for now, I'm talking with Adam from Kaiko. And welcome back, everyone. We've got Adam here from Kaiko. If you remember, he was one of our first guests for the show. Adam, welcome back.
Thanks for having me back. Always a pleasure.
You're in a different place now to when we last spoke to you, but kind of similar time zones. It's still Europe, right?
Yeah, I'm back in Paris now. I think last time we spoke, I was in Cork in the south of Ireland. So back in Paris, but keeping a keen eye on Cork. We were in the All-Ireland final yesterday and didn't go too well, but still keep your eye on home. Yeah.
Damn. Well, it would have been an exciting time to be looking at, taking your eye off sports for a little bit and focusing on some of the more, off crypto and focusing on some of the more important stuff. But if I remember correctly, we went through, and, for guests that hadn't seen it, you can go back to the episode, I think it was episode 1 or 2, probably 1 even, where we went through just a bit more to learn about like what Kaiko does, the data services it provides. And then something that I didn't know, but you guys do research, and that's something that is close to my heart because former equity researcher here, big into the data science kind of side of things, and you were telling us about the type of research that you guys do. And we're going to dive into that more, but just for those that didn't catch it, do you want to give a quick 30-second refresher about Kaiko?
Yeah, for sure. Kaiko
one of the oldest data providers in crypto. So we've been around since about 2014. We started off kind of humble beginnings, correcting all the centralized crypto data, doing some on-chain stuff. 10 years later, we've got every single kind of centralized exchange you can think of. We've also got derived data on that, so we do like implied volatility, evaluate risk, and other tools as well based off the data. And now indices as well is on-chain data like transactions, balances on Ethereum, Bitcoin, Solana, all these chains. And the research is probably, that's where I sit. And it's probably the most known arm of Kaiko in some parts, because, we kind of take opinions and like break kind of stories on, you know, major trends in crypto. Like, during FTX, we were looking at like liquidity data, and other, during Terra Luna, we were looking at like different metrics that were kind of like, showing things that were happening. So, it's kind of cutting edge research. That utilizes our product as well. So it's quite unique.
I was going to say, just in general, for anyone that's not from the crypto space, like in typical kind of capital markets, maybe even for people from crypto, we're used to stuff that happens quarterly in terms of announcements in the US, 6 months in Australia for earnings releases, and then it's like a month or two in arrears. So you've got this stale data as opposed to the extremity of like real time, but then trying to put some structure around that. But since our last chat, what would you say has been the most interesting kind of trends in data that you've seen across, whether it's the DeFi or RWA tokenization space?
I think like one of the most interesting things has been volumes and liquidity are down, and like I'd say Bitcoin, Ethereum, but so is volatility, so is everything. Things are kind of like calm, but we've actually notched like 123K, whatever the most recent high was. So it's been really interesting. It's kind of like a low volatility environment, but we're hitting kind of, even Ethereum's going up. Like Ethereum's near, I think last I looked last night, anyway, it was near 4K. So it's a really unique kind of market right now. In the past, over the summers, it's kind of been, you know, things quiet down. There's less volume, less action, and there's no kind of new. You wouldn't expect too many new price highs. And obviously, the last few summers have kind of broken the mold a bit, because you had 2023 of BlackRock applying for a Bitcoin ETF and Fidelity, everything like that. And then last summer things kind of ticked along. The Ethereum ETF launched, and that was busy July. And this year we've just knocked out like 123K Bitcoin. XRP hit a new high for the first time in, I want to say, like 7 years. And like, it was like crazy. Like XRP is nearly like $4 right now. The last time I think I was following XRP prices that high was probably in university, and I think it was probably like a moonshot that I thought was going to be the one that would make me retire early. But it's interesting for sure. And it's interesting that it's these sort of long tail assets that you wouldn't expect as well. You've got Ethereum Classic booming, and some other assets that were maybe popular 2 or 3 cycles ago. I think that's one of the most interesting things.
Yeah, it certainly is. Like you said, summer's usually been a quiet time, but the breaking of the mold has been happening. And for something that's supposed to be, at least from an outside perspective, volatile, you wouldn't expect that a low volatility environment is where, the money's being made. It's been, other things that are driving that, and seeing more instos in there, which is, a lot of great on-chain metrics I'm sure you guys have. We'll dive into that a little bit more, but just going deep into the rabbit hole, and we spoke about this offline, would have been great to cover it in that first episode, but it was just an intro. But, the framing this, there is this issue that we see in the crypto world where measures of what is good, or measures of what is not good, depends on a single metric, TVL. And TVL is great. We've spoken about that with others that are in the space, like that are doing RWA tokenization kind of works, like Red Belly Network down here. You would have seen Mantra and Ondo and Plume and others. But seeing TVL as the only metric is interesting, because whilst it's the most cited by DeFi dashboards and platforms, we know that it's flawed and incomplete. For the viewers that don't know why that is, what could you tell us, your opinions on that?
Yeah, no, it's a great question. I totally agree. I think it's kind of the same way I view market cap in crypto. Market cap is like everyone talks about, what's the market cap, but in reality, market cap isn't a good kind of, indication of tradability. And I think TVL is the same thing. it's not actually a good indication of the ability to transact and kind of, move funds around on those chains. TVL kind of, tells you the demand for that chain, maybe historically. It doesn't tell you the active demand. So I think it's main problems that I have is that it's static, and it's kind of can have some kind of redundant funds on there, money that hasn't moved in a while, or, protocols that are dead. And then you've got also the issue that it's not really, it's not a good sign of the actual ability to transact, do things on that chain. So we don't view it as a sort of like the be all and end all of, tokenization or anything else, even if you're looking at DEXs and other things. We see it as one metric among many, but there's other ways of kind of looking at the actual utility or ability to move things and do things on that chain.
I think that's a very good point, and one that, because I've seen some other talks about this and, gone back and forth with my assistants, aka ChatGPT, on this kind of topic, and knowing how to use AI the right way, ensuring that it doesn't hallucinate too much. But just further into that, do you think that TVL over incentivizes protocols and others to, say, inflate locked value without, say, necessarily improving that, what you spoke about there, that real world utility or like adoption? Does it lead to these kind of crazy incentives?
Yeah, I think for sure it's a bit of a zero-sum game, kind of race to the bottom or race to the biggest TVL. And it gives kind of, because I mean, in crypto it's very tough to kind of benchmark or look what you kind of want to measure where you want to go. And TVL kind of creates that simple, metric where let's get this and let's do this and then we'll have inflows. But I think it's changing slowly. I think, maybe 2 years ago, protocols were all about TVL. It was like, this protocol has X billion TVL or X 100 million TVL, and they're about to have a token generating event. It was kind of like, it was a thing. But I think we've slowly kind of moved beyond it. But it's still there in the background. It's still a metric that I think if you're a startup in crypto and you're raising, you're probably looking at TVL too much.
Yeah, I think it's certainly true. And there's more like devil in the detail as you go into it. Like, you don't know what you don't know until you're actually like doing this kind of stuff. And like the thing about a lot of folks that are starting to dive in, they see these initial headlines, but it's only once you actually start trying to get it adopted by businesses and used and being part of the workflows that it really shows you that there's different ways to count it. But we're still used to this sort of measure of like what DeFi Llama or the RWA aggregators show. But how does Kaiko think about, the metrics that better reflect actual kind of market health or user engagement, would you say?
Yeah, so like I think like we look at it a few different ways. I think if we're looking at it from the ability to actually execute and do sort of kind of complex transactions on chain, or to bring sort of traditional finance product processes on chain, you probably need a few different things. Like one of those is governance. One of those is like technical kind of complexity and developments. So how often are there updates in the chain? How many people are engaged with the updates? How many people are voting actively? And then also adoption is probably one of them. So TVL does still count. So you still look at, TVL numbers, but also is the TVL number growing? How recently is it changing? Not just if it's a static number that's been, over X 100 million or billion for 2 years, but actually has it kind of, there's been some kind of variation in that recently. So we look at that too, because we want to see a sort of adoption level that's still fresh and feeds into kind of our next metric, which is like network effect, because you want to see other institutional players on there. You want to see, how many people are, what percentage of that on-chain kind of activity is spread out. So not just, down to a few whales, but also like, there's actually active people on the chain. And we look at other things as well, like, stablecoin, fiat on-ramp, off-ramps, because the ability to actually go and transact and like put your dollars there is actually very important. So those are kind of two of the main areas, network integrity as well. We'll look at, recent previous hacks, audits, Nakamoto coefficient is something we look at too, sort of the concentration of activity on that chain. But we think it's, a whole encompassing thing. It's not just TVL. It's not just number of people on chain, not just active developers. It's sort of all of these things weighted, and to say kind of take a holistic approach and go, okay, actually, here's the value in that chain. And that's probably not, people will argue, and it might change over time, that, it's not fair to judge some chains on sort of their native token distribution. We'll look at Ethereum and say how many people hold ETH. Some people might say that's judging, a fish by its ability to climb a tree, but it is important. If you're a BlackRock, or if you're a Fidelity and you're tokenizing funds on chain, you're going to have to hold ETH to eventually, to pay fees or to pay transaction costs, and that's going to become an issue then if you're holding something that's highly centralized or highly, if there's other kind of points of failure with that token, you have to know about it. So we bring all of that in when we look at TVL, when we look at tokenization and the blockchain and ranking it. Yeah.
When you say you bring that in, is there like research that you guys create or are about to, or in the depths of creating, that looks at it from, I would say, like wider perspective? Because I think that would be really interesting. And on that note, like, are you aware of any other competitors? We don't even have to say names that are doing this kind of stuff, because this does harken back to what you would traditionally see in the equities markets and even in fixed income, where you'd see a Goldman Sachs or whatever kind of research report that looks at a particular industry and breaks things down by these like multiple metrics. Is that what you guys are looking to do?
Yeah, I mean, like, that's kind of like the mission of Kaiko in a lot of ways. Like, we look at exchanges on the centralized front. So, like, we rank exchanges every quarter. I work on that, and like that has liquidity ranking, data quality, technology, business score. We do kind of like, a top-down approach to ranking exchanges. And we do the same thing with assets, where we look beyond liquidity, and we also look at tradability, the availability of different fiat pairs, things like that. And yeah, we're doing it now with kind of tokenization and ecosystem ranking. So, there's going to be a report out in the next couple of weeks. I don't want to give myself a hard deadline here, but it's the summer months in the Northern Hemisphere. But yeah, we've got a ranking coming out where we're kind of hoping to give a sort of, AAA, AA rating to different ecosystems based on this kind of like, broader approach that we have. So like, bringing in network effect and, ability to transact on chain, all those different things, as well as, uptime percentage, security, number of audits. So looking beyond TVL and giving a sort of top-down rating, like you probably would have done back in the day in like, equity research, things are buy and sell. We're sort of saying, this is a AAA rating to kind of like, transact on that chain. We're trying to do the same thing. Yeah. Bring kind of traditional standards to crypto.
I think it's really important because with that sort of thing, you get a proper baseline. It's almost like as if we were only judging whether it's ETF or equities or other kind of traditional markets just by, say, market cap, as you mentioned. If that was the only way to measure things, then, it would be kind of crazy. But just comparing TradFi metrics to what we see with on-chain in traditional, you have more mature sets of metrics for assets, asset health. We've got NAV, cash flows, other sorts of ratings. Do you think that the way that we were doing things in, say, traditional markets, we would have like some sort of equivalency here? So for example, like I worked with a group, Canadian Investment Bank. We had a system of rating stocks. We looked at value, we looked at quality, we looked at momentum factors, and each region, like each individual stock had their rating on that, which formed an industry, which formed the country, which had, Australia's really good at this kind of style and others are, so in terms of grouping, it may be different, but do you see yourselves like just say creating just like the ratings, or are you seeing like categories just much like what we had in traditional kind of markets, where we could say that maybe crypto does, I mean, especially because there's so much more pricing stuff, we would have momentum factors. But do you see that there are some things that map one-to-one, and then there's others that are quite unique because it's crypto?
Yeah, I mean, like in certain areas, we've got Kaiko indices, which is like our index business. Definitely it maps kind of like quite similarly. We actually are launching our own factor kind of index range soon, looking at momentum, looking at size, things like that. And then, on the exchange side, on the asset side, we're kind of bringing those best practices in. So we're kind of trying to set that standard similar to what you have in traditional finance. So again, a lot of my colleagues would have come from, we're in Paris here, SocGen or BNP Paribas, other banks. They've got that kind of like traditional chops, and they've kind of done that, and they're bringing those best practices into their role at Kaiko and into crypto. But also, you have to kind of, bring what you know from your own background, but also kind of respect where you're going. And when you're in crypto, some things have to be kind of be done a little bit differently. You have to be nimble. So it's not always one-to-one. There are areas, in the indices side, it can be one-to-one, and we should bring those best practices in. But on other ways, it has to be sort of, you have to be nimble. You have to sort of adapt it to the industry you're in. And like, I think, tokenization on chain, like data, that's one of those areas, because like people think of crypto and think, oh, you can see everything on chain. And it's like, it's true in a way, but if you're playing around with Solana, tracking wallets and looking at data there is a little bit trickier than if you're playing around with Ethereum or Bitcoin. So you have to kind of like drop the preconceived notions of what crypto is and be able to kind of like meet it at its face value. Which I think, you look at some traditional kind of approaches to crypto, and they look at maybe Metcalfe's law, the sort of network effect of like new users, and they measure it that way. Or like, maybe you can do a DCF on Ethereum, but it's not going to translate across all chains. So you have to kind of case by case basis, which is probably a little bit tougher for some of the finance folks. They're used to having a sort of model and being able to work within that. But the model's changing in crypto the whole time, and we're kind of, yes, we're trying to kind of catch up and put the best practice in place. But yeah, you have to kind of, in 6 months, there might be a new metric that we have to kind of be aware of. So we have that process in place. We're ranking exchanges and assets. We have a kind of quarterly oversight committee that looks and says, hey, should we introduce this metric, or should we use this to look at that? And we look at it from kind of legal, tech, analytics, indices, and research my side. So yeah, you have to kind of, we're not right there yet where we can kind of have these perfect models, these perfect frameworks to use, but we're getting there. And I think that's like the role of like Kaiko and service providers, and that, we can implement those best practices. We're independent. We're not kind of, we've got no dog in the game in terms of, some firms are owned by exchanges or, other things. And we're just a data provider, an analytics firm. And, we're doing our best to kind of institutionalize crypto in a sense.
It's not even like what do you call it? Like aggregators that are owned by exchanges, but it's even news sites that are owned by exchanges that you've got to watch out for. So it's interesting. You mentioned there before, like that there is a uniqueness to this, but do you think that there? Would you say, and this is your opinion, obviously, but like, what's one metric that you'd want every person in, like, say, DeFi, crypto, RWA to track daily more than just TVL? What's your next? What would be your favorite that you'd like to see people talk more about, as an example?
I think I'd like to see people more focused on actual activity on chain, actual development. So like, we look at active developers. We also look at sort of like GitHub rel, like kind of commits, and like, people who are actually using like, engaging with the chain. Those things I think are two very important things, because, you can have chains or you can have protocols. And then, and there was a protocol like maybe a year ago, friends whatever, one of those
Friendtech.
Yeah. And it went live on a token generating event, and there's been no activity whatsoever in the sort of year and a half since. So we look at those things. We look at kind of activity of developers and people actively working on the chain, because there's chains out there that are sort of, some of them are dead on arrival, or others have kind of not had much happen to them since they kind of pushed out a token and the vesting cycle is over, or something like that. So active developers is one that I really watch. We also look at, I think other areas like, I talked about it already, but like security and audits, those are very important, because if you want to get the BlackRocks of the world on chain, they're going to need to be comfortable, and like right now they work with firms like Securitize, who are sort of a nice in between, where they're kind of a broker for them on chain. So, you've probably got to imagine that most of that transacting on chain, everything happens through that broker. But we're going to get to a world where, there's probably someone at BlackRock or there's someone at Fidelity, and they're interacting on chain, they're paying those fees, and they're doing that with their tokenized money market funds. So security and audits are very important, and the ability to kind of know where your money is going and who it's going to, because if you're these firms, you can't work with sanctioned nations or people. So you're also going to have to look at where these validators are based, node operators, and like say, okay, that someone in Venezuela has been validating this chain, and actually I can't interact with them because that's a sanctioned country right now. So those kind of things are going to be important. So I guess transparency on chain, but that also feeds back into, like, I think this is a huge thing when I first got into crypto in 2017, of these sort of enterprise blockchains, and like, oh yeah, it's going to be privacy focused, and people kind of scoffed at it. But I think the ability to be private and public and kind of switch between the two is probably going to be important, because if you're a JP Morgan or a BlackRock or one of these guys, you probably don't want people, always tracking what your fund's doing. You like the idea of instant settlement and, the ability to kind of optimize that kind of pipeline or the transactions and settlements. And, but you're probably not too chuffed about, everyone being able to see what you're up to. So there's a place for those enterprise blockchains or those kind of sort of privacy first focused chains. We've got the ability to switch between two.
Yeah, I think it's certainly going to be interesting. And we just finished up, since we last spoke, not centralized like my firm, we were selected as part of the Reserve Bank of Australia's Project Acacia, where it's the third round. They tested in 21, very private, few selected, private kind of closed loop of CBDC, and it was more talk than, testing things on chain. That in 23, private version of Ethereum, testing more non-programmable CBDC, and then people had to bridge between that and do things in a programmable way with a stablecoin or a token, within a network. And then now there's 24 pilots and POCs, 19 pilots. We're one of those testing securitization. I'll send you some more stuff on that. But it is one of those where they had to select networks this time. And for the first time, they actually selected a public network that has permissioning on it. It's that KYCs, that has that best of both worlds, as you said. And, that's Red Belly Network. There's also Hedera, R3 Quarter, others. But we're certainly seeing that trend. So I think there's going to be more on that, like with use cases like this. Other countries we know are testing, and this is necessary. You're absolutely right. Like JP Morgan, BlackRock, they're not going to deal with stuff where you just don't know who that other person is, or who even the node validators are. Like, you can't have something where there's that risk, right?
Yeah, I mean, like we saw that when the Bitcoin ETFs first launched, the Ethereum ETFs, and people were dusting the wallets, sending random NFTs and like other small tokens to BlackRock's sort of wallets that they kind of figured out by kind of like sleuthing. And you can see where the wallets are. They're not public from BlackRock's side, but we can kind of track them easily enough. So you saw the kind of issues that you have there. Crypto's still quite a mature space sometimes. Someone wants to launch an NFT and then send it to BlackRock wallet, and then they put that on their website. Who knows? So like, that's one small area, but also, from a more structured kind of day-to-day approach, you have to have validators, different things like that. And as you say, the permission blockchains, we're a super validator on the Canton network, which has kind of attracted a lot of, institutional kind of interest. Like, I remember writing about Canton back in 2022, 2023, maybe, I think it was, when I was at the block. And it was like, first coming on the scene, it was like, had Microsoft and other like firms kind of testing it out. We're still working on that now with other firms who are still there. And there's a reason, because, it's got that kind of permissioned ability to be public and be private. And as you say, Red Belly as well, things like this. It's probably the next logical step. And it's interesting to hear that Australia are doing that, like, with actual, going beyond just kind of use cases and looking at, all right, what chains are we going to work on? That's quite cool.
Yeah, and it's real money too. So 19 of the pilots are testing real money. In our case, like, there's an end-to-end value chain that's being mapped out and being put on chain for the fixed income space, from receivables to bonds being created, and then to a buyer of that would showcase like how things actually work in the real world. So I'll send that to you. And then others are testing their stablecoin or other fixed income, like real world things, all in a wholesale sense. But it is this kind of wave that we need because I believe that the future is just going to be, okay, blockchain will transform by not really needing to speak about blockchain anymore, because it'll just be part and parcel with technology and finance. But speaking of future trends, and just to wrap up here for now, and we'll get you back on for another, in the future is obviously things will change. There'll be the research. We'd love to cover that when that gets released. But trends that you're seeing in tokenized treasuries, bonds, RWAs, stuff beyond the TVL hype. But what are some of the trends that you think will start to take place and shape? And obviously, I think you guys will be part of that. But what do you think will happen there in terms of trends?
It's a good question. I think, what we've seen the last 2 years has been, Franklin Templeton have got Benji or whatever, their fund where they've got, tokenized. Then next thing you have BlackRock with Biddle, and there's a lot of others. Circle has just acquired Hash Note, I think it was earlier this year. So that's going to continue, I think, the tokenized kind of fun thing. But I think it's going to be separate from stablecoins, because the first kind of 2-3 years of this, we've seen it as like, oh, yield-bearing stablecoins. But, I think the instance of a stablecoin having yield that's going to someone else as well is tricky. It creates issues, especially in the value chain. Like if I'm holding that stablecoin and I've got holding it like cash in an account, shouldn't I get an opportunity to kind of benefit from that upside? And it's not happening for a lot of people. So I think that's going to change. You're going to kind of separate out where that kind of happens. So there'll be specific stablecoin, specific funds, because I think to be a stablecoin, definition of that is to probably not to have yield, just to be, keeping your peg and keeping the price. So I think we're going to see kind of tokenization of money market funds, things like that, separate a bit. The whole point of crypto is kind of democratizing finance. And right now, it feels a little bit like my old UK bank account, where I could get access to I think it was 1% interest, and the rates were over 5%. So that's happening right now. I think that'll change. And next, I think we're going to see more than that. These have been a nice use case, and yes, it's money involved, but I think we're going to see maybe a move to other things, repurchase agreements happening on chain, things like that. Probably, I think one of the next logical steps as well is sort of the solidification of the sort of risk-free rate in crypto. I see a lot of people talking about it. People say it's Ethereum staking yield, but then on the other hand, you've got these tokenized funds that are offering you US Treasury yield. So that's still the same risk-free rate that we would accept in traditional finance, which I sort of kind of lean towards. But other people are saying have a Ethereum staking yield, things like that. I think that those will be some of the bigger trends, moving beyond just tokenized money market funds. More discussion and more kind of research and development into what the risk-free rate is in crypto, and more exciting, exotic kind of things happening on chain. And that also means things like, data layers and applications for understanding on-chain transactions more. Because, Ether scan is great and things like that, but that's where we sit. We work on these chains so that we can kind of make sense of that data easily. And it's not just TVL, as you say, it's also looking at those kind of security audits, looking at kind of variance across tokens and things like that.
I think it's going to be it really is a Wild West, because this is the first time that we're seeing the creation of these sorts of new types of ways to tokenize. Like you said, it could be repo markets, and then there's the whole educating the traditional, not traditional, but the retail kind of market that is so intertwined with crypto. Now they've got to learn what repo markets are. And it'll be up to us to help educate them and make it something just simple, because obviously they will want to invest as much as they can when something is new and it's got this upside potential. But there's a learning curve there. But I think the more maturity that is coming, there's a bit of an educational uplift, as well as new markets that are being created, as well as new types of ways of measuring with the data side of things, which you guys do so well. So it's certainly going to make for some interesting times over the next couple of weeks, I would say.
Yeah, for sure. And more conversations for us to have as well. So it's nice.
Absolutely. Well, look, Adam, thank you so much for your time. We'll see you again soon. We'll keep an eye out for the reports that you guys are working on. No pressure, obviously. It'll come out when it comes, but we'll look forward to chatting further. Thank you.
Thanks for having me.